What is going on, everybody? We have made it to another Tuesday. We are back for Home Financing Hacks on Tuesday. So thank you for joining me this evening. It's going to be a good one, as they all are. So yes, it's exciting to be here. Actually, I've got a sticker on today. So my 5-year-old wanted to give me a sticker today. So I was like, you know what? I'm going to wear it. And I forgot to take it off of the broadcast. So it's just going to rock with us throughout this broadcast. If you caught the title, we are talking about student loans today. So it's going to be a good one. We're talking about how to buy a house with student loans. And a lot of people have a lot of student loans, and a lot of those student loans aren't much benefit to those individuals because they were not able to get jobs that actually help pay for the student loans and the quality of life that they want to live. So that's a whole nother conversation, a whole nother story for maybe a different day. But in any case, student loans do not have to be something that prevents you from being able to purchase a home. You can purchase a home even if you have student loans. And so we're going to talk about how that can be possible regardless of how much you have in student loans. So to get started off, first and foremost, whatever's listed on your credit report, a mortgage loan officer or a mortgage lender is going to have to calculate a payment for every debt that's listed on your credit report. So when you have a student loan listed on your credit report, that student loan usually has a payment listed for what the minimum monthly required payment is. And that's the payment that the mortgage loan officer is going to utilize in order to determine how much debt you have to pay every month. And that's what they add to your debt to income ratio to decide how much home you can qualify for. However, a lot of people in recent years, and yours may be including today, have a student loan that is currently in deferment. So you're not making payments, meaning that when a loan officer pulls your credit report, there is no payment that actually shows on your student loans, or on your credit report rather. And so when that's the case, if there is no payment that's being shown because your student loans are currently not being paid on because they're in deferment, then a mortgage loan officer is going to have to calculate a payment, and they calculate that payment according to the guidelines that they're writing you under for the loan that you're looking to get. So for example, if they're using an FHA, if you're going with an FHA loan, they may use 0.5% of the outstanding balance as what your minimum required monthly payment would be for that student loan. So what does that look like? If you had $50,000 worth of student loans, 0.5% of that $50,000 would be $250 a month. And that's what a mortgage lender would have to calculate as far as what your minimum monthly payment would be. So that can put a dent into your ability to be able to purchase a home, because just a $250 a month payment for student loans could cost you $30,000, $35,000 in purchasing power. If you have $100,000 in student loans, which isn't uncommon, especially with the cost of college and universities today, that $100,000 means that a mortgage loan officer is going to have to calculate $500 a month towards your monthly payment, or towards your debt to income ratio rather. So $500 a month out of that student loan payment that they would have to calculate towards your debt. That's something that can really put a dent in things, because that $500 could cost you $75,000 to $80,000 in purchasing power, meaning that if you could qualify for, let's say, a $400,000 home, well, now you add in that $500 a month student loan payment that your loan officer calculated, and now you only qualify for about a $320,000 to a $325,000 home. So maybe you were able to purchase a home for $400,000 where you live, but maybe you can't find a home in the $300,000 or $320,000 price range. Or maybe you will qualify for a $300,000 home and now you're down to a $220,000 or $225,000 and you can't find anything in that price range. So you can see how just a student loan payment calculation can cause a lot of people to not be able to qualify to purchase a home. Now, the way that you can navigate around that is what we're getting into this evening, which is a income-based repayment. You also might have heard it called a IDR, or an income-driven repayment. Same thing, same concept, just two different names. So basically what an income-based repayment is that whoever you owe your student loans to, let's say you have government student loans, you go to the servicer of your student loans and you request for a income-based repayment plan. What they're going to do is they're going to look at your income, how much you're making. and then they look at your debt, how much you are paying in debt every month. And then based on those two things, they come up with a number that they believe is appropriate for you to be able to afford to pay on a student loan. And so that ends up being what your student loan calculation is. Now, when you have an income-based repayment plan in place, the number that the student loan servicers come up with for your income-based repayment, that's the number that now a mortgage lender can utilize to drastically decrease how much they have to calculate when you're getting approved to purchase a home. So what that looks like is, let's say, for example, if you have, let's just say $100,000 in student loans, and they're currently being deferred. So the mortgage lender has calculated $500 a month on a monthly payment for those student loans. Now, you go and get an income-based repayment plan put in place, and that income-based repayment plan says that, you know what, your student loan payment for all of your student loans is going to be $67 or $78. So now you, instead of having to have $500 a month calculated against your student or against your debt to income ratio to purchase a home, now you're only calculating $67 or $78, because now whatever's on that income-based repayment, that's what a mortgage lender can utilize for your student loans. And that's how you can be able to purchase a home with student loans and everything, because mortgage lenders don't actually have to utilize all of the calculations. They can just utilize what's in that income-based repayment. Now, it's important to note that when you are having these income-based repayment plans put in place, include all of your student loans in that plan. That's the key that's actually tripped up a lot of people, is that they don't include all of their student loans in that plan. For example, when you take out student loans, you might not have taken out $100,000 all at once. Maybe you took out $20,000 once, $7,000 here, $15,000 here, $14,000 there. So you took it out in different phases as you needed it. And now you end up with, 15, 20 different student loans that have different amounts. When you go to get your income-based repayment, you want to have all of those student loans included in that income-based repayment, because what I've seen happen is that you actually have some individuals who only have, let's say, half of the student loans included in the income-based repayment. So what ends up happening is that a mortgage loan officer will look at half of those student loans and they'll say, okay, the payment for all of these student loans is $78, and that's what they can go for. That's what they go with. But now they have this other half that was not included in the income-based repayment plan. And now they have to use 5% of the outstanding balance for each one of those loans. And that number can add up. For example, let's say you had one student loan for $20,000. Well, 5% of that $20,000 is $100. So they got to do $100 for that. Whereas you had all of these student loans that you have to only pay $78 for, or $50 for, or whatever the number is. But just that one now is costing you $100, and they have to use it for every single one that was not included in that income-based repayment. So when you're getting these plans in place, you want to make sure that you include all of the student loans in there. Now, it might not be possible to include all of them in there depending upon where you got some of these student loans from, because, for example, you might have some government loans, but you also might have some private student loans. So those might have to be dealt with separately. But as much as you can, try to include all of your student loans in there, because the first thing that a mortgage lender is going to do when they look at your income-based repayment plan, they're going to look at the account numbers for each student loan that you have, and they're going to see which ones are included in this income-based repayment. And that way they can just use that one number for all of your student loans. And the ones that aren't included, they're going to go make separate calculations for them. Now, there have been times where, well, I'll put it like this. I have never seen a time where the 0.5% that a mortgage loan officer has to calculate is more than what a income-based repayment plan amount comes out to. I'm not saying that it's impossible for it to be more. I'm just saying that in all the people that I've helped and all the people that I've counseled, that I've navigated through student loans into home ownership, I have not had any of them that have done an income-based repayment plan, and the number that they had to pay, the amount they had to pay for the income-based repayment plan was actually more than the 0.5% that a mortgage loan officer has to calculate. I've never had that situation. Not saying it's impossible. I've just never had it happen, and I've never seen it happen. So overwhelmingly, the majority of the time, whatever you get for your income-based repayment plan is highly, highly likely going to be much less than what a mortgage loan officer is going to calculate for your monthly payment. Now, you have some individuals that will say, you know what, they don't want to do an income-based repayment plan because they don't want to start paying on their student loans. Their student loans are being deferred. They don't want to start making a payment. And this is what I say to you or to those individuals. There are times where it is worth it for you to actually make the sacrifice and start paying on those loans earlier. And this is one of those times. You are going to be making the biggest purchase of your life. And so with that, it might come with some sacrifices. You might have to start paying on those student loans, and it might cost you $100 or $150 a month or less. But in any case, most people waste $100 in a month every single month. This is something in which is actually going to be benefiting you because the money that you're spending is helping you to purchase the greatest purchase of your life, the biggest purchase of most people's lives, which is the home that they're going to own. And it's an appreciating asset, meaning that it gets more valuable over time. So by making that sacrifice, by saying, you know what, I'm gonna do this income-based repayment plan. I'm gonna get this thing in place so that I can, have what I need to be able to purchase a home. That's something that's actually gonna benefit you more because by saying, no, I don't wanna do it, I'm gonna save $100. But guess what? The $300,000 or $400,000 house that you could have qualified for had you done it, in 1 year, that $300,000 or $400,000 home might appreciate 4% year over year. Because 4% appreciation has been the average appreciation over the last 60 plus years. And so that's why I use 4%. It might appreciate 4% year over year. And so what's a 4% appreciation on a $400,000 home? We're looking at $16,000 more that you would have gained in equity in your home, but you didn't want to pay $100 a month over the course of a year or $150 a month. So you start to see how this doesn't really add up when you break it down and you look at the investment in yourself and in purchasing a home for yourself and for your family versus saving $100 a month that you don't have to pay on student loans. Do what you need to do to make sure that you can get in the home as well. So a couple of examples. I have spoken with and know a couple of individuals who have actually done, I know more than a couple, but in telling you a couple of the stories that I have from personal experience, I know one individual in particular who has about $120,000 worth of student loans. However, this particular individual that I was working with did an income-based repayment plan and had the income-based repayment plan, the amount that they had to pay based upon that plan is $10 a month. Think about that for a moment. All your student loans get wrapped into this income-based repayment plan, and it ends up being $10 a month that they ended up having to pay. Now, I'm not saying that's going to be your situation. You might have to pay more than that or less because, again, it's based on your income and your debt obligations as well. But $10 a month, that's a pretty good deal. I know of another individual that I worked with. This was actually a couple years ago. This particular individual came to me and said, hey, I want to purchase a home, but I have a lot of student loans. Credit's good, but ton of student loans. So they had over $200,000 worth of student loans. The 0.5% that I had to calculate for their student loans was over $1,100. With that much of a monthly payment going towards students' loans, this individual didn't qualify. But I told this individual, hey, you should look into doing an income-based repayment plan because odds are they're going to calculate a monthly payment amount that's much less than the $1,100 that I have to calculate based on underwriting guidelines for an FHA loan. So this individual they set up a income-based repayment plan, came back to me, showed me the paperwork for over $200,000 worth of student loans. The income-based repayment plan had them paying less than $250 a month for all of their student loans. That individual was able to go on and close and purchase a home. So I say that to paint the picture that regardless of how much you have in student loans, regardless of how much you think your student loans might be working against you, it's worth it to at least tap into seeing what you might end up having to pay per month if you were to do an income-based repayment plan, because that is something that a mortgage lender can utilize rather than the 0.5% of the outstanding balance that they have to calculate according to FHA or conventional underwriting guidelines. So that's what I have for you. Hopefully this has been beneficial, short but sweet, but I wanted to give you something beneficial because I know a lot of people out there are struggling with student loan debt right now. I see it a lot, and this is one way that you can navigate around it. It does not have to be something to stop you from being able to purchase a home. So get a hold of that income-based repayment plan, see what it is that you might have to pay, because it might be a better route that's going to move you closer to being able to purchase that home. As always, we're going to be here every Tuesday. So next week, we're going to have another good one for you. Just giving you the tips, the tricks, the tools to move you closer to home ownership. Thank you for taking the time to tune in. Take care, be blessed, and we'll see you next week.